you can determine where it is that the market is heading from a low point or a high point. Every low point represents demand, because from here you will notice that at demand zones, price start to buy. If you go to a higher time frame, you're going to see things from a bigger perspective and a more persistent perspective, meaning the price you see is going to hold and be more significant versus going into a small time frame. All right, let me make a sub example. If you're looking at a demand zone, right, that is typically a base, a low point in the market, where we can see clearly that from here there started to shift. There was a shift that started moving the market to the upside. Whenever we see that, we understand that not only this is a demand zone, but it is an order block, because only market makers, high institutions, Citadel, JP Morgan, HSBC, Deutsche Bank, Bank of America, Barclays, these are large institutions that have large amounts of money that can move this market, and nobody else can do it like they can. So when price is coming from a high, from a zone like this, from a demand zone, typically when we see price come back to it in the future, then we're like, oh, okay, price must be retesting that zone, revisiting that zone, and eventually we will see it buy up, right? This is how we see price bounce off of a zone, and we're able to tell, okay, if it keeps bouncing off of here, then this is a good demand zone. And we can tell that it is a good demand zone because we looked in the past, and we see the last time price came, flirting around this area, hanging around this zone, they started to move from here. Okay, does that make sense? Am I losing anybody? Am I doing good so far? And let me remind you, I see 16 people on the call now. I hope y'all don't walk away from your phones and start to do anything else, because I'm not paid to do this. I'm really trying to help. I'm trying to help the community understand more. Okay, so the fact that price comes from demand zones, that means that if what's the word I'm looking for? There's a word that's in my head. I'm trying to really if price has a demand zone, that means there's a range where price has to get to where they're losing the demand because price is getting too high, right? Or if we're thinking about it in a perspective of, like, let's say you guys are selling a product. For instance, my hat, Catch Pips and Chill. That's my brand right here, right? It's Forex Fashion. If I have 200 hats in a box, right? What's happening if I keep selling it and I'm down to 10 hats? Supply's running low, right? So if supply is running low, then I'm going to have to re-up. Make sense? So in a way, when you're looking at supply and demand and you see prices reaching a zone of resistance, a zone of supply, then once price starts to kind of break altitude here, you see prices breaking structure, aka whatever zone that we saw here, these bases, we're starting to see that wherever price had a higher low to make a higher high, as price starts to kind of lose altitude, we can tell, oh, it seems like price is losing that momentum. So a lot of times, though, we will see price do that, come back to retest the zone, but fail to go higher. So once price starts to do that and behave like that, then we know that price is most likely going to be selling off back down to zones that are more discounted, aka back to the demand zone, just to re-up. Y'all get what I'm trying to say, right? Okay. So it is just like when things are out of stock, you have to restock. All right. And this concept is the same concept for most markets, if not all. Okay. And while I was looking at these questions, I remembered, I actually heard somebody in my head say, hey, the same way humans that have two legs need to take one foot to go forward and another foot to carry on, right? The same way humans have to go left foot, right foot to walk is the same way markets have to do higher highs, higher lows to move. The same way, if we have to step backwards, we have to take one foot and another foot to take a step back, a full step back, right? It's the same way the market has to do lower lows, lower highs, and lower lows to go back down. Did that click for everybody? So it doesn't make sense to be asking, oh, what pair does moves the best with this indicator? It's the same thing everywhere. It's the same thing. Once you understand the concepts of what makes the foundation of a market, right? It's the same, it's just the same lingo. It's the same lingo, it's the same structures, except for the fact that just like humans, right? Some people are tall, some people are short, some people get angry fast, some people talk slow, right? But we're all human. So it's just like gold. Gold moves really quickly and aggressively. It moves very it has a lot of large ranges, but at the same time, it is still an asset class. It's still a market that we trade. So in order for you to get comfortable with a pair like gold, you got to realize, man, whoo, you know what? Gold's not my speed. You moving too fast. I like slow people. I like people who talk slow. I like to pace myself. I'm just getting in the game. I can't be messing with you. You're a little too advanced for me. Let me go find me a pair that matches my style a little bit more. Okay? Preference. The same way most of you guys are probably currently dating or in a relationship. Before you got to that point, you had to figure out what you like, what you didn't like. So when you are having a product, a software like AIRO, it doesn't stop there, right? Somebody can suggest to you what they like, what their preference is, but your preference might not be somebody else's preference. But the fact remains that these markets have the same foundations. In fact, market makers invest in all of these asset classes just to make money, because market makers have to be the ones that market makers are basically the limbs of the market. They have to do the left foot, right foot, right? They have to be the ones that move the market left, right, north, south, and that's the only way this market moves. So this is why you have to understand supply and demand. You have to understand what the order blocks are. And at least those two, when you're starting out, you have to understand what that is. The third thing you really need to understand with these markets is structure. Because with structure, you won't have to worry too much all the time about asking what is the best TP, what is the best stop loss, because the situations and scenarios aren't always the same. Does that make sense, guys? The scenarios are not always the same. I will give you an example. If I'm looking at this market and it's playing within this range that we see here, right? And price dipped to the bottom, and I can see that price is going to reverse. I'm interested in seeing price go up so I can take a trade for the buy. And then now, since I realized that they just made a U-turn, And since they made a U-turn from this zone right here, right, there's very less chances that price is going to be going below this point. But at the time I'm seeing this scenario, price is here. So now I got to figure out, man, if I put my stop loss below here to prevent my trade from taking any bad losses or, eating and chewing my account away, I'm going to have to put my stop loss below here. What's the distance? 153 pips. Can I tell somebody, oh, the best stop loss is 40 pips for this trade? No, because that's not going to satisfy the scenario. So right off the bat, I don't know if this is clicking to you, but it's going to come a time where you're like, you know what? I need to tighten up on my preference because I don't want to take a trade that requires 153 pip stop loss. You know what? That's it right there. That's not my trade. That trade does not fit my preference. Let me just move past this one. I'll find another trade that's going to fit what I like. That's going to be better for my account. That's going to fit my risk to reward ratio better. Okay, so this is why, like, sometimes I'm trading live with you guys and I'm literally just, you telling me about this pair and I'm like, okay, yeah, so this is what's going on with that pair, but I'm focusing on this today. Yeah, I'm okay, GBPAUD, that's amazing, but I'm focusing on this today because I know what's gonna work for me today. I can tell that if I get in here at the very earliest point, my stop loss is gonna be here and I'm gonna be fine. And if something goes south, I'm gonna be fine because I'm risking $30 on this trade. I'm not gonna have to put my stop loss 45 pips away in this scenario. This one is my preference. So I cannot tell everybody, that, oh, on a general standpoint, it's 40 pips stop loss and, it's 20 pips TP all the time. Okay. So I like this question right here. What is the difference between order blocks and supply and demand? A supply and demand is a zone. It's a range where the price is trading for. Okay. Example, gas prices. If you drive around your block at least 1 to 2 miles, the range for price is going to be $4.25, $4.30, $4.10, $4.15. That would be your range. Okay. That is a range between where price is trading for in a zone. An order block is what significantly shows you the force and influence of the market makers as they shift the market a different direction, and you can see it, you can pinpoint it. I'm looking at it right there. It's glaring to me. This is an order block in a supply zone. So we can tell that this is what shifted the market to the downside, right? Because only market makers can do that. So this is a bearish order block, right? Because this was that up candle. You can see in this area, we saw that there was a little bit of an effort to push the market up, but we saw that price literally influenced and moved it significantly to the downside. That is an order block right here within a supply zone, because we saw that price is too high off their own supply and now they got to go down. Did that clarify it for you? Does that make sense for everybody? There's 14 participants. I will make sure that I don't miss. I will make sure that I explain it to the point where you understand it. That's why I took some time out of my day today. Okay. Now, The next question, I'm pretty sure somebody's asking this, man, but so that means order blocks are everywhere. You're right. So that means we have to really just bring it down to the ones that make the most sense, so that way we're not overwhelmed. For instance, here's an order block right here. How can we tell it's an order block? We can see that from here, price was selling, and then whoa, where did all this buying volume come from? This must be a bullish order block within a demand zone area, because we see that there was demand for price here all the time, and demand is usually a base where price keeps on coming back to, just like gas prices. Why are gas prices still at $4.20 everywhere? $4.20 as the average price. That would be a demand for price currently right now to meet the criteria of gas supply and demand, right? Meaning how much they're going to be selling it for, how much they're going to make in revenue, and when they bought the price for so and so amounts per barrel, this is the revenue they're going to be making off of our hard-earned money. All right, I'm throwing a little shade here, but what I'm trying to say is, but valid order blocks you spot where it was strong break of structure and goes for supplying. I think you could have written that better, but I think I know where you're coming from. So how do you know that an order block is actually an order block, right? We have to see that it's coming from a zone of supply and demand that was visited before. And if it wasn't visited before, we need to see a significant shift, because there's nobody that can move the market like the banks do. So if price was clearly pushing up, and then we see that price from that point just kind of change the narrative, then there's chances are there are some order blocks in that zone. Okay. And what the zone is going to be is either a supply or a demand zone. Okay. So how do you spot an order block? Of course, we need to see it at least react off of a demand zone or a supply zone. We're like, oh, okay, that's an order block. So we mark it down, because most times price does come back to retest the area, and then typically history repeats itself. We can clearly see it here. Price came from here on the 17th, bought off of it. Came back here again, bought off of it. Came back here again, bought off of it. Not only is this a demand zone, but we can see the order blocks that move and shift the market, as if you forgot something hot that's cooking on the stove at home, and then you all the way, west on whatever street you live. You're like, oh snap, I gotta come back to the house because I forgot to turn off the stove. That's that significant shift that we can see in any market, which represents the order blocks within supply and demand zones. All right. Now, to add to what you just said, Doman, yes, significant break of structure definitely identifies that this is either a supply or demand zone, and an order block is definitely what caused it to move all the way over there. There's high volumes coming from that point of interest. Make sense, guys? So if price is coming from an order block and history likes to repeat itself, then when you're looking at charts on arrow's side, right? It's disconnected. Okay, let's not worry about that. We can map out this thing without arrow, right? You can see that from here, if price comes back again, then since we're anticipating the same type of scenario, then when we are waiting for the same thing to repeat, then we have to figure out where to put stop loss if we were to take a trade expecting it to go down. So when we see, like, for instance, on arrow, we see that this zone would be red. And then not only that, we see that there's 2 red zones here. That means it is a strong resistant area. So when price bounces off of this strong wall here, What would happen if you're jumping and bouncing off a trampoline and your head hits the ceiling? You're gonna come down. It's a simple science. You're gonna come down. So since price fails to go any higher than the ceiling, then as price is going down, then we can start getting into trades that are not that are sell trades, right? So when you're getting in sell positions, then the stop loss would be best placed behind the order block. So if in this case it's 32 pips that you have to sacrifice, then that's what it's going to have to be. Because we're trying to distance ourselves away from what the potential scenario could be if price goes higher. But now we're going to make sense that if market makers have large orders moving price down from here, that means it's going to take a lot of money to move it past this point. So what better way to move alongside the market makers and use that knowledge against them as well by putting our stop loss behind the order blocks, above in the supply zone. Or the same thing goes for a demand zone, right? Price pushes, comes back to the demand zone. All right, you know what? We're going to take that buy, stop loss below the previous low, expecting a buy. Now, let me continue and transition into take profit mentality. When price starts to buy, it's typically looking to target areas that were previously lower highs or higher highs and stuff like that, right? And in the case of a demand zone scenario, if price is bouncing off of demand anywhere within where price visited before, it's fair game. It's just going to have to be up to your strategy to decide how many pips out of this potential that you want. So if you can tell that when price bounced off of here, when price was selling off, we see all these beautiful long candles, right? That means once price bounces off of the base and has nowhere else to go, then it's going to have to start buying. So if price starts buying, then we can tell that we can go for 20 pips. All right. We can go for 30 pips. We can go for 60 pips. Why? Because the potential makes sense for us to do that. Now, let me also say this. Every area that you see here are potential take profit areas because there are previous highs that price must go in that direction and reverse or retrace, right? As they carry on towards the next targeted areas. So if we see price do this, higher high, right? And then they start to buy up, then there's potential for us to hold on to the trade. But if price pulls back, guess what? Then you have no business in being in that trade still. So when you're trading, you have to trade with the mindset of what could potentially happen when price is moving into an area where they need to go target liquidity, meaning where the money is sitting above the lower highs and lower lows or higher highs and higher lows. So this is why, like, when you're trying to identify where take profit is, you need to keep in mind whatever happened on the left side as price went down, those are going to be the zones and targeted areas that price is going to be looking for as they retrace and go higher and retrace and go higher until they go after these zones, right? This is why when price made it up to this resistance, they pulled back down. Somebody's coming in now. Missed a lot of gems, right? They pulled back down. And then they continued higher because it is an uptrend. Now let's take a look at what happened with Nas 100 today. I almost forgot. I'm on the inverted scale, right? So last night we were trading. I think we started here. We were trying to get in the trade. At first, price was consolidating the whole entire afternoon in Asia session, right? But if we're taking good look, we can see that where the higher lows were on the prior days will be the areas where price targets if it's going to go down. So since price is at a ceiling zone here, we need to be waiting to see if price is going to be breaking structure. What is the structure? The base. So then price broke the structure, pulled back, went down just a little bit, came back to retest the supply zone where the order blocks are, and then they broke structure again. Where is price heading? Well, if you look to the left, every previous higher low were the zones that they were heading towards. They will get to that targeted area. They will pull back, right? What is that? A lower high. Then they pushed further. Why did they push further into here? We can tell that they went right into this area from the day prior. Boom. They took out that liquidity and then they retrace. So if price keeps on getting weaker and weaker, guess what's going to keep happening? It's either price is going to pull back a little bit more into the order block in the supply zone and then break even further below. But if you look to your left, they are specifically going in areas where the candles had imbalance, where the candles needed to be rebalanced from the areas where they came from on the left side. And as they do that, they will retrace. Then it will fall, and then boom, boom, boom. And then they start to hit these schematics that you might not see or not think about, but this is how they play the role, right? But intentionally, you will notice that your take profit ranges will be areas where price had visited before on the way down. The same thing if price is going on its way up. So that's why, like, if you're trying to decide where take profit is, you need to realistically think how far price can go before it reaches resistance and retraces. So now you guys understand why I say take profit is subjective, right? So while price is averaging these movements, you're like, typically when price is moving like this, on average, I can tell that this pair can give me 500 pips. This is Nas 100, right? So I'm like, you know what? Let me settle for just the average that I can catch out of this pair, because I see that more times than not, price is going to give me 400 pips or 40 points. Okay. But I need to be strategic when I should enter. Why? Because it is always safer when price is bouncing off of demand ready to take off. If we miss this part, that's a higher high. Okay, cool. Let's wait for the higher low when price is cheaper for us to get in, so that way we can catch the wave on its way up here. And once price creates a higher low, that means we can put stop loss below the previous low for safety. So now if we're like, okay, that can help us kind of mitigate the risks better. I'm like, if I put my stop loss here, right, 51 points, expecting to make 65, 70, or even 100, that's a good risk to reward. That means I could risk $45 to make $80. I can risk $45 to make $100. But if price is moving right in the middle of traffic here, personally, I don't like to get in because it might be difficult for me to tell how far I got to put my stop loss, right? So that's why, like, per maximum, I'm like, man, if I miss the move, I'm going to have to wait for it to come back just a little bit, right? Same way you drive around looking for a price to be at least 3 cents less on the gas. Clearly, the topic today is gas, right? So that's why, like, it makes sense to understand structure, because if it's creating higher highs, it has to pull back for a higher low. At the higher low, we take the trade with the stop loss below the previous low, right? If price is falling down, making a lower low, that's not when we get in, because the lower low turns into a lower high. So if we in a sell trade at the lower low, we're going to get pummeled. We're going to get wiped. We're going to get scraped, whatever you want to call it. So that's why last night when I took this trade with the team, right, we got here, price clearly fell into a lower low, right? Let me go to a higher time frame. I was like, price made it into a lower low. Well, if the rules apply, a lower low turns into a lower high. Okay, let me counter trade then. Let me take a counter trade buy, because I'm expecting if this is a lower low, then you should be making a lower high. And by that time you do that, let me see, where was I? I think I was, I'm on the 4 hour. That's why. Okay, let me go to the 1 hour. Let me go to 1 hour. I'll be able to tell that each candle represents 1 hour. And this is where we were. So we were like right here. I saw price kind of pushed off of this demand and went past this area right here. So I'm like, okay, so price went past it. So that means that's a higher high, higher low, right, into a smaller structure. But clearly on a larger structure, this is a whole lower low, which should be turning into a lower high. So on a smaller time frame, when I was in the 5 and the 15 minute, I just wanted to make sure price pulled back the right way for me to say, all right, we're going to take this buy. We're going to put stop loss below the low. Worst case scenario, price falls back down. Man, you know what? 40 pips was the preference. This is as far as I'm going to go risk wise. Okay, so that's why we're like, okay, take profit is going to be at least above here. Why? Because if price is going to buy, then they're going to be targeting these previous highs, right? Because if we're having higher highs, higher low, then where's the higher high going? The higher high is going to go above that lower high or this lower high. And what did we do? We went and pushed, went above that lower high, pulled back, which means when price does that, you need to close your trades, right? Because a higher high turns into a higher low turns into a higher high. So we get in at the higher low and we exit at the next higher high. Did you guys hear me? You get in at the higher low, you exit at the next higher high. Because once price gets to the target and makes it to the objective to take out liquidity above that previous high, it's going to pull back. So the game is to try and get in the pips that you can see is ranging the market or moving the market before it gets here or once it gets there. So if your goal and your strategy is 20 to 30 pips, you're going to get that 20 to 30 pips if you understand structure. And it works for every market. It just, the only thing that's different is the speed of how fast it moves and your account size and how much you can handle in fluctuation. Question, comment, answer. I'm going to give you guys the opportunity to unmute yourself Please, if your background is noisy, be like, no, 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 no. Let me mute myself. All right. So I'm gonna unmute. Hold on a second. All right. So did that make sense for you guys?
Yes.
Yeah, that makes a lot of sense.
Yes.
Great. What actually made sense for those who are saying, yeah, that made sense? Like, what was something that you needed to, like, what clicked? You're like, oh shoot, dang, that made sense. Like, this is the part that made sense the most for me. Which one is it?
When you draw the supply and demand zone, even though you didn't write supply on demand on the zone, it just makes more sense to just look and observe like, okay, price is not continuing to go down or price is not continuing to go up. So let's wait to see where price needs to go next because that's something I'm working on a lot. So that made a lot more sense seeing you draw it out
Perfect.
with the
Perfect.
rectangle.
Right. And we got to remember supply and demand zones are like ceilings and bases, you know? So when we have ceilings and bases, if price can't make it past that ceiling, then all right, then it's going to come down and it's going to be looking for base areas to uh target as liquidity, you know? So I'm glad that made sense to you. Who was that?
Me,
Don?
Jaquel.
Ah, Jaclau. Okay. My bad. I'm trying to hear voices today and make sense of it. All right. So now we can see when price bounced off of this green zone. Y'all can see my screen, right?
No.
No.
Nah, bet. That's gonna change in a second. Boom. All right. So now when you're looking at the charts and you see price pull back and bounce off of this zone, you're like, oh, okay. I can consider taking the sell with my stop loss above the zone. If the S pops up for a sell, even better. We can even add another position because this should be telling us or confirming to us that, oh, okay, bet we can get in. This is a strong sell trend and we can catch something at least until price makes it past this support. And then, hey, you know what? At least by around this point, we should be considering to exit our positions. Okay.
Yes.
All right. So as you guys can tell, I wasn't really focused too much on trying to break down red light, green light. I think Jackie and Nate does a fairly good job, and there's so many content. But I know for sure that what the crowd needs is to understand structure, understand supply and demand, understand order blocks, right? These things are what moves the market and gives you insight on understanding, like, okay, what is going to be my destination point here? What is going to be the distance that I keep away from the market and protect myself and call it a stop loss, right? Realistically, how do I navigate through these ranges and create a good strategy for myself, right? So that's what I really wanted to talk about. And I think there's not really much that needs to be said from here. And I'm just glad for those of y'all who had time to jump on, caught some good gems, right?
Yes.
Yes.
Mhm.
Is this going to be, I know you're recording it. Are you going to be posting it as well?
Oh yeah. I'm definitely gonna be posting this recording.
Thank you.
Mm-hmm. So yeah,
Before you jump off, do you recommend start off with like the Forex peers before you jump to the indices?
absolutely.
Gotcha.
I will say though, S&P 500 is like a real good, smooth index to trade, but it's not as crazy and volatile. And you can actually open up like 0.01s and still be good. You know what I mean? But disclaimer, make sure you have an account that's like uh at least $300 to $400, right? To make the right risk. And when you're losing, when you're in a losing trade, if it's more than $20 and you have a $300 and $400 account, start cutting losses short. Right? If it's more than $40, ooh, you're a little too deep in the risk department. Okay, so when you see things are not moving your way, quick to cut that off. It ain't nothing to cut it off. Right? You make the rules, not the market. Set the standards. Same way you have standards in your life, you have preferences in your life. If this pair doesn't work for you, it doesn't work for you. It doesn't have to. Okay, it works for Nick. Yeah, it works for Hans. It doesn't work for Albert. That's it. we can't stoop low for the market if we don't stoop low for anybody in real life. Does that make sense?
Yes.
So keep that same preference, keep that same standard, keep your head held high because it's your money, right? It's your money. So we can't let the market just do whatever it wants with it just because we need money. Now we're operating on a low vibration level. So when I started seeing that, I started putting that kind of posture and confidence on the charts. I'm like, okay, you got me, market. It's cool, but I'm the trader here. I got arrow. I got red light, green light. I'm gonna come out on top regardless. I'm just gonna let you have this one, but we're gonna run it back. It's cool, right? This is my fault. You got me. I was in my, in my feelings, but it's cool. I still got $300 left. And there's 3 days left in the market, and there's 4 days left in the market, right? And I'm gonna leave this last little nugget. Remember what you're trading for. If you're trying to replace a job income, remember to pay yourself. If you made $300 for the day, 300 divided by 8-hour shift is $37 per hour. If you made $500 today, if you made $100 today, remember how much energy it takes for you to book a client. Remember how much energy and gas it takes for you to drive somewhere. Remember how much of an annoyance it is for you to wake up early. And remember how much discipline you still need to wake up early to pay yourself. Remember how annoying your boss is. Remember how you hate people. Remember how you hate customers complaining, but now you're a customer and a boss. So treat yourself with respect. Figure out how much it is that you need to be withdrawn often, because in a world in this trading space where they say 90% of trade or 99% of traders fail, this is a market where you will take losses. But if you're paying yourself in any of these conditions, who's still winning in the end? How did I lose if I made some money?
Okay. Like that.
Right. I still come back. I'm only losing if I'm not making a dime and I'm only giving everything back. But if I made some losses and I still paid myself, hey, who here does not drive their car to work? Still have to pay the car fees, right? Insurance, car note, right? And you're losing mileage every day in the car, but you gained a paycheck. So if you are coming into the space and you want to be a full-time trader, you got to look at the numbers that way. You got to look at it in that type of perspective. If not, we're not really account managers. We're here to make bread. So sometimes, like if you're trying to take $1,000 to $3,000, that's fine. But remember to pay yourself along the way, just in case. Okay, because whatever you lost, but you realize you've been moving and saving. Oh snap! I got $700. Yeah, I mean, shit, the account is up. Like, I took $300 for a loss, but I still saved up a good chunk from taking these good trades for 20 and 30 pips. Okay.
Yes.
Mm-hmm.
I like that. I like that.
I think I've spoken. I preached. I think a lot of sense was made here. A lot of sense was made here. All right, guys. So that's all I have for you. I think we did pretty good on time.
Excuse me, fam. Can I ask a quick question before you leave?
Go ahead. Quick question. Quick.
Regarding the order blocks, my problem has always been entry. it's like I think I'm seeing the order block, and when I enter, a lot of times I enter going in the wrong direction. So I'm not sure, you know, what I'm actually seeing. If that makes sense.
Yeah, it does make sense. Everybody goes through that sometimes. I have one-on-ones that I do, right? I will help anybody who actually needs to refine their entries. That is what I focus in on. If you've been on my calls, you see like a lot of my entries have been pretty crispy, pretty sharp. And I have ways I can help you guys with that. But my time here has come to an end. I will go over some of those things too on my calls, right? But if you need that extra help, you know, we're gonna have to keep working together on that. All right. Now,
Okay.
you guys are using a very powerful tool. Time yourself with the entries, because there will be candles that reveal themselves to you that this is an order block, because price will start doing a U-turn. Catch the hint?
Yes.
Mhm.
You don't have to jump the first time around. Give it some time. Give it some time. Like, let a candle or two just, you know, start going the opposite way. Okay.
Patience.
Mm-hmm.
Mhm.
Yep. All right, guys. So
Thank you. Thank you so much.
for sure. And we're gonna stop it right here. And
Appreciate you.
yes,
Yep.
yes.
Thank you.
On.